Hi, hello, welcome to our. In continuation with the last class, we are discussing that income tax credit. Now we are discussing section 18. What is there in section 18? This is section 18 related to some special circumstances enabling availing of credit. That is, in some special cases, in one cases which can be person can claim the input tax credit or can avail the input tax credit even though he is not a registered person as on that date. That is if any person entitlement of ITC on inputs into stock and contained in finished goods or work in progress and capital goods, and at the time of registration, voluntary registration, or come into regular tax paying status by existing composition levy, or on coming into tax paying status on account of exempt supply became taxable supply. So who is the person having some input stocks or finished goods and their inputs, and the person is at the time of registering or voluntary registering. If a person came into registration, so if he is a person obtaining the registration for voluntary basis, person obtaining voluntary basis, and that person exist some inputs relating to working progress, relating to finished goods, relating to another capital goods, then or reversal of ITC on inputs into in stock and contained in semi-finished goods, working progress and capital goods, that is at the time of exist from regular tax paying status by opting from composition levy. The person who is a registering person, already registered person, switching from composition levy to regular scheme, and that person having some input tax credits related to semi-finished goods and finished goods and capital goods. And next, reversal of an amount payable on supply of capital goods or plant and machinery on which ITC has been taken. Who is a person applying for registration within 30 days from becoming liable registration, or already registered person, and exempt supplies became taxable. Now exempted becomes taxable. In that four cases, how can we identify the ITC and how can we claim the, and what is the condition to be claimed to ITC in these four cases? So entitlement of ITC at the time of registration or voluntary registration, or switching to regular tax paying status, or coming into tax paying status, that is exempted from becoming taxable person. So here there is some credits related to stock, input stock, or semi-finished products, or finished products, or capital goods at the time of that registration or voluntary registration and coming into regular tax paying, or at the time of from switching from composition to irregular. So in the four cases, how can they avail the credit and what are the conditions was existed? So first case, if a person applying for registration within 30 days of becoming liable for registration, if a person already existed business and his turnover crossed 20 lakhs or 40 lakhs based on states, from that date he will become liable. So as on date of exceeding the turnover, the person has some stock that is related to working progress or finished goods or capital goods on that ITC, that is input L on stock and input contained in semi-finished or finished goods or L or stock. So he has stock. Next, entitlement of ITC, the day immediately preceding the date from which he becomes liable to pay tax. So when he crosses the turnover and in preceding that day, if you have an input relating to any amount that is in relation to semi-finished products or finished products or capital product, and the day immediately preceding the date from which he becomes liable, then if a person applied for registration within 30 days from becoming liable for registration, then he can claim the ITC which is exist before registration time, that is first person and ITC to be availed within 1 year from the date of issuance of the tax invoice by the supplier. The supplier must be this recipient who is registering now, the invoice must be within 1 year, then only ITC can be availed. Next, in second cases, if a person obtaining voluntary registration, in above case the person liable for registration and from that day to 30 days will be taken. If the person is applying for voluntary basis, inputs as on date held means what is the inputs relating to semi-finished products or finished products or capital products, anything the inputs existed on the date immediately preceding the date of registration when the registration is obtaining, and that date will be calculated. And here also the same, that is the ITC availed within 1 year from the date of issue of invoice by the supplier. Next, third person, registered person who ceases to pay composition tax pay and switches to regular tax pay. If the person is crosses the turnover limits like 1.5 crores, I think 1.5 crores for normal cases, and in special cases 75, special category state 75 lakhs, or in if he taken registration under section 10(2)(a), then 50 lakhs. If the crossed the turnover, he will lapse from composition tax pay and he switch from composition to registration. When he came to registration and as on date he has some stock, that is inputs held on stock, and inputs related to finished goods and capital goods. Here he must be have some related to inputs, so he may claim that inputs as on date of switching date and the day immediately preceding the date from which he becomes liable to pay tax under regular scheme, and he must satisfy some conditions. That conditions will be and same to the other person, that is who is the registered person. Exempted supplies becomes taxable supplies. So in first when he is taking the registration, the goods will be exempted. After 6 months the goods became taxable, and after 6 months the person has some stock, finished goods, capital products. On that input stock, finished goods and capital goods, the person will be eligible for taking the credit. So they will satisfy these conditions. What is this? ITC and capital goods will be reduced by 5% per quarter of a year or part thereof. In case of capital goods, where there is a capital goods used exclusively for exempt supplies. Capital goods in case of exempted supply becomes taxable. Capital goods used exclusively for such exemption then reduced by 5% per quarter or part thereof from date of issuance of invoice. Here ITC shall be verified with the corresponding details become furnished by the corresponding person, and ITC to be available within 1 year from the date of issue of tax invoice by the supplier. So in 4 cases you will eligible for input credit as on date that is related to semi-finished product ITC or finished product ITC or capital goods ITC. If in any case it is a exempted supply case, taxable now become taxable, then that capital product is exclusively used in exempted supply, it will be reduced by 5% per quarter or part thereof from the date of invoice, and this ITCs will be examined. ITC will be verified with the corresponding details from corresponding to the corresponding details. And here also that ITC relating to avail must within 1 year from the date of issuance of invoice by the supplier. This is the cases, and then here in 4 above cases you must availing the IDT, but we need to satisfy 3 conditions. So 3 conditions must be satisfied. What is that 3 condition? That is first condition related to filing of electronic declaration. Electronic declaration giving details of inputs held in stock, contained in semi-finished goods and finished goods held in stock and capital goods on the day immediately preceding the day on which credit became eligible. So when you became the eligible, that credit is taking to availment, that day you must file a declaration, electronic declaration. And second condition will be details declaration has to be filed within 30 days from become eligible to avail credit. So if you converted from composition to normal taxpayer from on that date to 30 days will be considered. If you your goods exempted to taxable from on that day to 30 days, within 30 days you must declare the declaration, electronic declaration relating to that in ITC available and you are availing that ITC creditor. Next, in case if the above amounts, if you are certifying the amount, that is if the amount credit related to that amount more than 2 lakhs aggregate claim of you are claiming, the amount will be more than 2 lakhs, that is CGST, SGST, IGST or UTGST, that then that amount will be certified by the CA or cost accountant, chartered accountant or cost accountant must be certified. That is related to special circumstances enabling availing the credit. Okay, such for example number 41. Z became liable to pay tax on 1st August and has obtained registration on 15th August. So within 30 days he has taken the registration. So Z is eligible for ITC and inputs held in stock and as part of semi-finished goods or finished goods held in stock as on 31st July. So from 1st August preceding the day will be 31st July. Up to 31st July he can claim any inputs exist as on that date. Next, Z cannot take ITC on capital goods. Z cannot take an ITC. Cannot take an ITC relating to capital goods. In case of liable for registration and person obtaining voluntary registration, they cannot get the capital goods ITC. Only the persons who is switching from composition levy to regular scheme and the person who is converting from exempted supplies to supplies become taxable. These two persons only they will claim the an input tax input on capital goods and input on capital goods. So next, A applies for voluntary basis. A applies for voluntary registration on 5th June and obtain registration on 22nd. He is voluntarily registering on his own on 5th June and obtains registration on 22nd June. Okay, A is eligible for ITC on inputs held in stock as part on semi-finished goods or finished goods held in stock as on 21st June, that is preceding the registration obtained. He cannot take ITC and capital goods. So persons who is applying for registration within 30 days from liable for registration or persons obtaining voluntary registration, they cannot claim the capital goods ITC. Next, B, a registered taxable person. He is already registered taxable person, was paying tax under composition scheme. So he is paying tax under composition scheme. Up to 30 July he has paid the on composition scheme. However, with effect from 31st July, B becomes liable to pay tax under regular scheme. Maybe its turnover crossed the specified turnover. Then B will be eligible for ITC and inputs held in stock and inputs contained in semi-finished goods or finished goods held in stock and capital goods as on 30 July. On 30 July, ITC and capital goods will be reduced by 5% per quarter from the date of invoice. So here on capital goods only 2% will be eligible. That 2% will be registered person switching from composition scheme to regular scheme and person who is exempted supply to becoming liable. Already registered person can claim the capital good ITC, but person who is newly registering or voluntary registering, they cannot get the ITC of capital goods. Next, reversal of credit or payment. In some special circumstances, what we will reversal of credit and payment of amount will be arise. What is the cases here arises? Here also same 4 cases will be arise. 1 2 3 4 5, maximum 4 cases will be arise. That is section 18.4. Section 18.4 requires reversal of ITC when the registered person who has availed ITC and switches to composition levy, or when he supplies get wholly exempted from tax. If a person registered in normal taxable person and he has claimed a ITC, existing ITC, and now he is switching from regular to composition scheme, then he must revert the ITC relating to that what he has claimed. Next, ITC and inputs should be reversed proportionately on the basis of corresponding invoice on which credit has been availed, on which credit has been availed. If the invoices are not available, then if such invoices are not available, then prevailing market price of effective date on switch over or exemption over or cancellation of registration would be considered. So if this person is reversing the amounts, first he will see the corresponding invoices. If the corresponding invoices is not available, then go for market price of the product, and details furnished on the basis of prevailing, that certified by the practicing chartered accountant and cost accountant. Chartered accountant or cost accountant must certify that related cost is correct. When if a person went for market price, that is capital product related. If a person went for capital goods, reversal on pro rata basis pertaining to remaining useful life, that is taking life of as 5 years. Here example number 44, capital goods has been used in 4 years, 6 months and 15 days. So what is the life of use? 4 years, 6 months, 15 days was used. Next, the remaining life in month will be 5 months, ignoring part of the month. So 5 months was the remaining life of the asset, and ITC taken on such goods is equal to C. So ITC attributable to remaining useful life will be C. What is the ITC exist into 5 by 60 will be considered. Next, the registered person has the debit and electronic credit ledger or cash ledger by the reversal amount in respect of the such amount that is related to input held in stock or finished goods or finished product immediately preceding the date exemption. It will be debited as such amount which is required, and balance ITC it will be lapse. Balance of ITC it will be lying in the electronic credit ledger will get lapse. Next, cancellation of registration or same cancellation of registration also same, that is person who is input held in stock containing semi-finished product held in stocks and capital goods on the day immediately preceding the date on which the over the date exemption cancelled, date of cancellation, and same manner will be utilized. What is the manner? And proportional reversal will be used for capital goods, finished product and the date. If the invoices exist, go through with the invoice. If the invoice is not exist, then it will certify by the C or cost accountant used in market rate. And in case of capital goods reversal on pro rata basis pertaining to remaining useful life, taking useful life will be 5 years. Relating to ITC reversal on inputs, will be calculated separately for ITC of CGST, HGST, UTGST and ITGST, and reversal amount is added to the output tax liability of the registered person. Here reversal of which amount you want to reversal, that amount will be added to the output tax liability. And electronic credit ledger, if any excess electronic credit ledger, the amount debited has such amount and balance ITC will be lapse. Next, amount payable amount payable on the supply of capital goods or plants and machineries. In some cases, capital goods or plant machinery on which ITC has been taken. If you are taken ITC, now you want to pay, you as per rule 40 and 42, you require to pay the tax amount to be paid is in case rule 46 or rule 40 or 44. If capital goods or plant and machinery on which ITC has been taken, if the person who is used for capital goods or plant and machinery on which ITC has been taken, he must pay the amount of equivalent of this, that is higher of that is ITC on such goods reduced by 5% per quarter of a year or part thereof for the date of issue of invoice for such goods, or tax and transaction value of such capital goods or plant and machinery. Now on capital goods in normal regular finished product or stocking products or related to that products will be taking normally, but in case in supply of capital goods, the plant and machinery, then here the higher amount of this, that is ITC taken on such goods reduced by 5% of per quarter of a year or part thereof from the date of issuance of invoice. You should consider and reduce 5% for every quarter. Remaining useful life, ITC pertaining to remaining useful life, or tax and transaction value. What is the transaction value as on date, and use the tax rate and multiply it. Whichever is higher will be considered for reversal. Next, ITC pertaining to remaining useful life of capital goods should be computed separately. ITC remaining useful life of life of capital goods should be computed separately for ITC of CGST, SGST, UTGST, ITGST. Next, tax paid, where the amount so determined if the amount so determined exceeds the tax payable on the transaction value of the capital goods, such amount need to be paid and thus should be added to the output tax liability. That reversal amount will be added to the output tax liability. Next, if refractory bricks, molds or dies or jigs or fixtures are supplied as scrap, the taxable person may pay tax on the transaction value. Here there is no option, you must pay the tax on transaction value. Means how much you have collecting the amount, then that amount will be taxable. In the rule 46, ITC involved in the remaining life of the capital goods is reversed on pro rata basis, taking useful life as 5 years. Next, in case transfer of ITC on change in constitution of registered person, who is registered person and changed his constitution. Now he want to whatever unutilized ITC. Now whatever unutilized ITC, he want to transfer that unutilized ITC to which is constitution of registered person. If in case of sale or merger or acquisition or lease or transfer of business where there is a unutilized ITC can be transferred to new entity. If there is a specific provision for the transfer of liabilities to the new entity, the inputs and capital goods so transferred should be duly accounted for by the transferee in his books. If you are transferring the unutilized ITC from the old firm to new firm, it must be accounted in transferee books of accounts. In case of sale, in case of demerger, ITC is apportioned in the ratio value of the entire assets, that is including assets on which ITC has not been taken off. ITC not taken on new units as per demerged scheme. What are the details you should require? That is details changed in constitution. Of registered person. changed from or to be furnished on common portal along with the request to transfer unutilized ITC. Change in constitution of registered person. Unutilized ITC. Now here CA or CS. CA or CS. That ITC, how much is ITC? It must be certified by CA or CS, cost accountant or chartered accountant, to be certifying the changes in constitution has been done with a specific provision for transfer of liabilities. Transfer of liability ITC 02 form will be filled. Next, upon acceptance of such details by the transferring on the common portal, the unutilized ITC is credited to his electronic credit ledger. If any unutilized ITC exists, that amount will be credited to the electronic credit ledger or the resulting firm or the new firm. That is this case. And for the purpose of apportionment of ITC pursuant to demerger, the value of assets of new units is to be taken at the state level and not at the all India level. Only transfer would be required to file the form GST ITC 02 only in those states who both transferor and transferee are registered. Only the state wise will be considered here, not India wise. If any person having 10 registrations in 10 states, if one state is going for demerger or one state is going for merger, then that one state is required. Remaining 9 states is not required for filling of ITC 02, and certification is not required for other persons. Only this form which is filing ITC 02, that form only liable for ITC 02 filling. For example, a company XYZ is registered in 2 states, in MP and UP. So the company is registered in 2 states. Okay, 2 states is was registered. Its total value of assets is worth 100 crores. While its assets in UP are MP UP are 60 crores in MP, 40 crores in UP. Okay, respectively. It demerged a part of its business to company ABC. As part of such demerger, asset of XYZ amount to 30 crores are transferred to company ABC in state of MP, in state of Madhya Pradesh. So while assets amounting to 10 crores only transferred to ABC in state of UP. So total assets amounting to 40 crores at all India level are transferred from XYZ ABC Limited. Here the unutilized ITC of XYZ in state of MP shall be transferred to ABC on the basis of ratio of value of assets in state of MP. Only MP state will be considered. That is 60 crores is out of 60 crores it was transferring 30 crores. So 30 by 60 is equal to 0.5 and not on basis of all India basis. All India ratio on value of assets, that is 40 by 100 is equal to 0.4. Similarly, unutilized ITC of XYZ in the state of UP will be transferred to ABC in the ratio of value of assets of state, that is 10 by 40 will be considered. 10 by 40 will be considered. When they are transferring, they will see on a state wise, not on overall Indian overall wise. Next, the ratio of all assets, the ratio of value of all assets shall be applied to the total amount of unutilized ITC of the transferor, that is CGST, SGST, UTGST and IGST credit. The said formula need not be applied separately in each heads, that is ITC each state. Further the said formula shall also be applied for apportionment of cess between transferor and transferee. For example, the ITC balance of transferor. The ITC balances of transferor X in the state of Maharashtra under CGST, SGST and IGST heads are 5 lakhs. So total ITC will be 5 lakhs and 10 lakhs. 5 lakhs for the states and 10 lakhs for respectively. 5 lakhs is related to CGST, SGST and 10 lakhs is for IGST head. Pursuant to a scheme of demerger, X transfers 60% of its asset to transferee B. So 5 lakhs CGST, 5 lakhs SGST, 10 lakhs IGST. Total amount will be 20 lakhs. Total ITC will be 20 lakhs. Out of 20 lakhs, he has transferred 60%. So 20 lakhs into 60%, that is 12 lakhs was transferred. You can show it may be one head, right? It is not no problem. Next, the total amount of ITC to be transferred to the transferee, that is sum of CGST, HGST, UTGST and IGST credit should not exceed the amount ITC to be transferred. Should not exceed the amount ITC to be transferred. However, transferor shall be at liberty to determine the amount to be transferred under each tax head, that is IGST, CGST, HGST, UTGST, within this total amount, subject to ITC balance available with the transferor under the concerned tax head. Here based on states assets ratio, transferee, tax heads, ITC balance, transferor, total amount of ITC. Apportioning means has on date of filing of GST ITC 02, total amount of ITC transferred to the transferee under GST ITC 02, ITC balance and transferor post apportionment at filing of GST ITC 02. That is in Delhi 70%, MP 40%, Delhi 70%, MP 40%, Delhi related to CGST, HGST, IGST, that is 10 lakhs, 30 lakhs, and total amount of ITC exists. ITC transferred will be 10 lakhs, 30 lakhs, and the total amount of ITC transferred to the transferee. How much they are transferring? 10 lakhs, 15 lakhs. Out of 30 lakhs, there is transferring only 15 lakhs. Remaining ITC balance of transferor, what is exist? 15 lakhs was exist. Okay, out of 50 lakhs, he is transferring 35 lakhs and existing 50 lakhs. Next, MP 40% case, CGST 25 lakhs, HGST 25 lakhs, IGST 25 lakhs. How much he is transferring? 3 lakhs, 5 lakhs, 20 lakhs. So he is transferring only some amounts, and remaining balance will be 22 lakhs or 20 lakhs upon 22 lakhs, 42 lakhs. Upon 70 lakhs, he is transferring 20 lakhs and remaining will be 42 lakhs. The apportionment formula shall be applied on the ITC balance of the transferor has availed in the electronic credit ledger on the date of filing of the GST ITC 02 by the transferor. Transferor will be considered. Next, for the purpose of apportionment of ITC, the ratio of the value of asset should be taken on the appointed date of demerger as specified in the respective scheme for demerger. Thus, for the purpose of apportionment of ITC, the ratio of the value of assets taken as an appointed date of demerger should be applied on the ITC balance of the transferor on the date of filing of GST ITC 02. Next, in case transfer of ITC on obtaining separate registration for multiple states of business within state or union territory. If you are transferring of unutilized ITC and obtaining separate registration for multiple places, in last case you seen that and transfer of unutilized ITC on account of constitution, changing the constitution. Now he is a person having one separate registration. For now he want to distribute that amount to multiple places of businesses. Section 25 will be enabled. So section 25 will be enabled. A taxpayer to obtain separate registration for multiple businesses in state, union territories. So the registered person having separate registration for multiple places of business within state or territory can transfer the unutilized ITC. Whatever the unutilized ITC he can transfer. So for this purpose, the registered person having separate registration for multiple places of business can transfer the unutilized ITC to any or all of the new registry place of businesses in the ratio of the value of assets held by the time at the time of registration. At the time of registration, what is the value of assets of that entity? Based on that asset value, it will be transferred. Next, value of assets means here value of assets means. What is the value of assets means? The value of entire assets of the business irrespective of whether ITC has been availed therein or not. Here value of asset means the entire value of entire asset of business irrespective of whether ITC has been availed thereon or not. Next, the registered person should furnish the prescribed details on the common portal within 30 days, within a period of 30 days from obtaining such separate registration. So the registered person should furnish the prescribed details on common portal within period of 30 days from obtaining such separate registration. Next, upon acceptance of such details by the new registered person who is transferee on the common portal, the unutilized ITC is credited to his credit ledger. If you are transferring, you must register within 30 days, and that person who is receiving transferring must accept that credit, then that credit will be goes into in his credit ledger, electronic credit ledger, that is related to transfer of unutilized ITC and obtaining separate registrations. Next, section 20, section 21, that is distribution of credit by input service distributor. Here input service distributor, IST, we will call as IST. When there is IST, here role of an input service distributor. When companies, ISD is an office of business which receives tax invoice from input service distributes available ITC to other branch office of same business. Here company may have their head office at one place and units at another place, which may register separately. The head office would be procuring certain services which would be commonly utilizing of all units across the country. The bill for such expenses would be raised on the head office. For example, in Kurnool I have one head office and I have branches in Telangana and Chennai and Karnataka. I have three branches at Chennai, Karnataka and Telangana. Head office was Kurnool. If any services provided there, I will send the persons to 3 states, and that person who is provided the service, he will raise the bill on head office at Kurnool branch for 3 amounts. Consolidated bill he will raise it. This is case the one person who is required for apportionment of to that states for Telangana and Chennai and Karnataka. Okay, accumulated amount will be utilized. Since common expenditure is meant for the business of all units, it is but natural that the credit of input service in respect of such common invoice should be apportioned between all consuming units. ISD mechanism enable proportionate distribution of credit of input service among the all consuming units. Here consuming concept of ISD used GST is legacy carried over from the service tax regime. Here what is there? See, there is person receipt of tax invoice for input service distributor by ISD. ISD will receive the person, that is in our case that is head office, my head office at the Kurnool branch, and he will transfer the distribute of credit of CGST, SGST, UGST, IGST by issuing the ISD invoice. Same PAN number. Next, here I will distribute that credit to the Karnataka branch, Chennai branch, Telangana branches. Next, this concept of ISD is a facility made available to business having large scale of common expenditure and where billing or payment is done for centralized location. The mechanism is meant to simplify the credit taking. Here process of entities and facility is meant to strengthen the seamless flow of credit under GST. So it is important to know that the ISD mechanism is meant only for distributing the credit and common invoice pertaining to input services and not for goods. So this input service distributor will distribute the input related to service but not for related to goods, only related to service. Here separate registration for an registration, separate registration for ISD. An ISD must require for separate registration. Even it may be separately registered, the threshold limit of registration is not applicable to ISD. Here threshold limit will not be applicable to that ISD. That ISD will not be applicable. The time limit, that turnover limit. Next, Can a company have multiple ISDs? Yes, different offices of company like marketing division, security division, etc. may apply for separate ISDs registrations. Here, manner of distribution of credit by ISD. Section 20. Read with Rule 39 of CGST rules. Here, ISD is required to maintain arithmetical accuracy. What he will maintain? He will maintain the arithmetical accuracy for how much amount he is distributing, how much required for distribution. So he must maintain that arithmetical accuracy and ensure that credit distributed does not exceed the credit available. Whatever the amount is credit exist, is that amount which is distributing this person, the distributing amount does not exceed this existing credit. Further, in distributing credit among different location of entity which are supplying the goods or services and have same PAN as that ISD recipient, it must follow these principles. So you must follow this principle, that is credit connected to an input services must be distributed only to the particular recipient to whom that input services is attributable. Input services is attributable. For example, in our case, the services was provided to only Chennai branch and Karnataka branch. Here Telangana branch there is no services. So in this case, I will in Kurnool branch, that ISD person must distribute only to Chennai branch and Karnataka branch, not distribute any amount to Telangana branch. So ITC and input service distributor only among the recipient to whom the input services are attributable will be distributed. Next, ITC is distributed among operational units only in the ratio of turnovers, in the ratio of aggregate turnovers in a state or UT on the recipient during the relevant period of the aggregate turnover of all recipient during the relevant period to whom input service being distributed is attributable. Based on their turnover, he will distribute. Next, relevant period is previous financial year or last quarter prior to the month of distribution for which turnover of all recipient is available. Here relevant period is relating to previous financial year or last quarter for prior to the month of distribution for which turnover of all recipients is available. Next, distributed ITC should not exceed the credit available for distribution, and both ineligible and eligible ITCs are distributed separately. ITC pertaining to input services which are common for all inputs is distributed to all recipient in the ratio of turnover. So if there is any common ITC, if there is any common ITC, that common ITC will be distributed to among all persons. If there is any ineligible ITC or eligible ITC, that amount also distributed to among that persons and distributed separately. And ITC of CGST, HGST, UGST, IGST are distributed separately. So separately you must distribute. And proportionate distribution of credit to be more than one receipt or all receipts. So the distribution receipt will be, there may be only one receipt, one recipient or all the recipients. So for working such pro-rata distribution, the turnover during the relevant period is to be considered for both the turnover of the recipient in state union territories as well as aggregate turnover for all recipient. Here relevant period means for working out the above distribution, is the relevant previous financial year if all recipients of credit had turnover in their states or union territories. Based on that union territory turnover will be considered for distribution. Next, if there are two or more locations, then of recipient in state or union territory, the sum of their turnover is to be considered his working out of the proportion of the credit that will be distributed to that registration. This is because PAN number will have single registration for all its location within a business vertical in state or union territory. Next, the credit attributable to recipient is distributed even if such recipient is unregistered or he is making exempted supplies. Next, where both taxable and non-taxable goods are supplied, the turnover excludes central excise duty, sales excise duty, central sales tax and VAT will be excluded based on if we considering the turnover. Formula for distribution of credit. What is the formula for creating the distributor? C1 is equal to T1 divided by T into T1 divided by T into C. That is, C is the credit to be distributed. C is the credit to be distributed. T1 will be the turnover of the recipient during the relevant period. What is the turnover existent relevant during period? That is the T1. And T, capital T, is the aggregate of turnover during the relevant period of all recipients to whom the input service is attributable. Input service is attributable. That is, distribution of credit is ITC attributable to specific recipient. ITC attributable to specific recipient, or ITC attributable to more than one recipient, or ITC attributable to all recipient. Distribution credit, how we can see? First, is this related to specific recipient, or is it relation to only one person, one recipient, or is this related to all recipient? If it is only one person, then distribute to such a recipient only. If it is for all persons or more than one person, then we will use for pro rata basis. Pro rata basis means that is ITC to be distributed is equal to total turnover of recipient. Total turnover of recipient having nexus with ITC during the relevant period divided by total turnover of all recipient will be considered. Here the turnover excludes central excise duty, state excise duty, central sales tax and VAT. And from the turnover will be considered for previous financial year or last quarter prior to the month of distribution for which turnover of all recipient is available. Next, in case ineligible credit also to be distributed in the above manner only. So next, example number 48. What is there in example number 48? ABC Limited, a confectionery manufacturer, has paid bills of an advertising company amounting to 24 lakhs for advertising campaigns for two varieties of cakes. So, ABC company, confectionery manufacturer, paying bills, advertising company 24 lakhs for advertising campaigns of two variety of cakes which are manufactured at a separate location in Pune and Bengaluru. The company had total turnover of 112 crores in the previous financial year. So, the company total turnover will be 1.12 crores. 112 crores in the previous financial year. The turnover of the Pune unit was 5 crores. Total turnover 112 crores and Pune turnover 5 crores and turnover of Bangalore unit was 10 crores. The aggregate turnover is taken will be 15 crores. 15 crores. We will not take the company total turnover. We will take the only recipient which the aggregate amount is transferring recipient person. Here transferring only these two cases. That is 10 plus 5. That is 15 crores. On advertising was for cake which are manufactured at the two units only. So the ITC is distributed between Pune and Bangalore unit in the ratio of 1:2. Therefore, Pune unit will be given ITC of 8 lakhs and Bangalore unit will be given ITC of 16 lakhs from the advertising bills. When distributing the taxes, you must follow this. That is ITC of CGST, HGST, UTGST in respect of recipient located in the same state, union territory, he is distributed as CGST and SCGST, UTGST respectively. And ITC of CGST, HGST, UTGST in respect of recipient located in different states or union is distributed as IGST. That is total ITC of CGST, HGST, UTGST which are distributed to such recipient. Next, ITC on account of IGST is distributed as IGST. So whichever tax is there distributed as that tax only. ITC on account of IGST. Next, if there is credit of IGST, it must be distributed as credit of IGST, credit of CGST or credit of HGST, UTGST. Recipient and ISD located in same state. If there is recipient and ISD located in same state, then it is distributed as input tax credit under the same category of tax, that is CGST, HGST. If recipient and ISD located in different states, then distributed as input tax credit as HGST. Next, note, section 20 provides that credit of HGST integrated tax distributed as integrated tax or central tax. However, Rule 39 of CGST rules provide that input tax credit on account of integrated tax shall be distributed as input tax credit of integrated tax to every recipient. Next, the example number 49. Example number 49. The corporate office of ABC Limited is at Bangalore. with its business location of selling and serving of goods at Bangalore, Chennai, Mumbai and Kolkata. So Bengaluru, Chennai, Mumbai and Kolkata. Software license and maintenance is used at all the locations, but for these services are issued at corporate offices. So the services are provided to 4 states, but the invoice will be received at corporate office. Since the software is used at all the locations, the ITC of entire services cannot be claimed at Bengaluru. Bengaluru is the registered place. Next, the same has to be distributed to all the 4 locations. For that reason, the Bengaluru corporate office has to act as an ISD. Here, Bengaluru will be treated as ISD to distribute the credit. If the corporate office of ABC Limited on ISD situated in Bengaluru receives invoice indicating 4 lakhs of CGST, 4 lakhs of IGST and 7 lakhs of IGST. So, total amount is distributed based on this. It can distribute the ITC of CGST, HGST as well as IGST of 15 lakhs among its location at Bengaluru, Chennai, Mumbai and Kolkata through an ISD invoice containing the amount of credit distributed. So the input tax credit portion was completed. From now there is illustration 1. What is this? Illustration number 1 is explained. Illustration number 1 will be XYZ Limited having its head office at Mumbai. Okay, is registered as ISD. It has 3 units in different states, situated in different states. So head office at Mumbai and 3 different states situated at different states, namely Mumbai, Jabalpur and Delhi. Which are operationally in the current year. They are working this year. Next, Mrs. XYZ Limited furnished the following information for the month of July. That is CGST paid on services used for only for Mumbai units 3 lakhs. So it will be attributable to Mumbai units. So the amount will be distributed to Mumbai unit only. Next, IGST, CGST, HGST paid on services used for all units 12 lakhs. If there is services for all units, you must be use IGST for distribution. This 12 lakhs will be distributed based on their turnovers. Here the total turnover of 3 units will be 10 crores. Turnover of Mumbai units 5 crores, Jabalpur units 3 crores, remaining 2 crores will be one state was Delhi. Determine the credit to be distributed by XYZ. Determine the of to each units in 3 units. Okay, 5 crores will be Mumbai units, Jabalpur will be 3 crores and 2 crores will be Delhi. Total turnover will be 10 crores. How much amount we are distributing? Only 12 crores. That 3 crores will be, that is 3 lakhs will be directly attributable to Mumbai unit only. So answer will be following like this. Particular credit distributed to all units, that is CGST paid on services used only for Mumbai units, that is total credit available 3 lakhs. This will transfer to Mumbai only. Next, IGST, CGST, HGST paid on services used for all units, that is distribution on pro rata basis to all units which operational in the current year. 12 lakhs is equal to Mumbai 6 lakhs, Jabalpur 3 lakhs 60 and Delhi will be 2 lakhs 40. That is 12 lakhs into for Mumbai 5 crores divided by 10 crores will be considered, and Jabalpur 3 lakhs 12 lakhs into 3 crores divided by 10 crores will be considered, and remaining balance will be unit Delhi related. The amount will be distributed. Here procedure to aspect for distribution of credit, rule 39 of CGST rules will be considered. When considering, here you must be provide that ISD has issued the ISD invoice. So who is the ISD here? That Mumbai branch is the ISD. You must issue the ISD invoice prescribing rule 54 of CGST rules for distributing the ITC. Whenever what amount they are distributing, it must provide the invoice. It should be clearly indicated in such invoice that it has you issued only for distribution of ITC. Next, the ISD needs to issue a ISD credit note as prescribed in Rule 54 of CGST rules. For reduction in credit, it is distributed credit goes to the reduced for any reasons. Next, ISD invoice and ISD credit note. ISD invoice and ISD credit note. If invoice will be issued for transferring the amount, if any amount is deducting, then credit note will be issued. Next, ISD and input credit note must contain the following information. What information is required in this information? Wherever the invoice is issuing, this information is mandatory. What is this information? Name, address and GST number of ISD and recipient of credit. That is name, address and GST number of ISD and recipient credit. Next, consequent to serial number up to 16 characters. One serial number will be provided containing alphabets or numericals or special characters or any combination thereof for financial year. Next, date of issue. Next, amount of credit distributed. Next, signature of ISD or is authorized representative. Next, relax for banks or financial institutions. If the ISD is a banking company or financial institution including NBFC, the documents for distributing credit need not be a serial number. So there is not required for any serial number in case of banking company or financial institutions. Only other persons require maintaining that consequent serial numbers. Next, ITC available for distribution in a month is to be distributed in same month. If the month amount related to this month, the amount will be distributed for this month only. If there is any pending amount for last year or previous year, that will not be distributed for now. Next, details of distribution of credit and all ISD invoices issued should be furnished by ISD in monthly GSTR 9. So GSTR 6, ISD will furnish in monthly GSTR 6 within 30 days after the end of the month. Within 30 days after the end of the month. The details in the returns are made available to the respective recipient in their GSTR 2 years. So when ISD file GSTR 6 and respective recipients will get the data from GSTR 2A, based on the GSTR 2A they will claim the ITC. And ISD is not required to file annual return. So annual return is not required for the ISD. Next, an ISD cannot accept any invoice on which tax is discharged under reverse charge mechanism. Here only the forward charge mechanism only accept the amount, and reverse charge mechanism he will not accept. This is because ISD mechanism is only facilitate distribution of credit of tax paid. So ISD itself cannot distribute any tax liability. He will not distribute any tax liability as a person liable to pay tax and remit tax to government. Next, if ISD wants to take reverse charge supplies, then the case ISD has to be separately registered as normal tax person. This is ISD related. Next, if he is issuing any credit note, debit note, credit note on ISD, then if issuing debit note, the additional ITC on account of issue of debit note to the ISD distributed by the ISD in accordance with the provisions discussed above in the month of which such debit note is included in GSTR 6. So you must include that information related to debit note in GSTR 6. Next, issue of credit note. If a credit note is issued to the ISD, the ITC to be reduced is apportioned. If you are using a credit note, it must be reduced. If you are issuing debit note, it will be additional to ITC. Apportioned credit note for the relevant recipient in the same ratio in which the original credit was distributed. So which the amount is distributed, no, that turnover based. In that turnover base only we will deduct the amount. Next, such apportioned credit is reduced from the credit to be distributed in the month in which the credit note is to be included in GSTR 6. If the apportioned credit exceeds the credit to be distributed, the same is added to the output tax liability to the recipient. If the amount is excess, So then the amount will be added to the output tax liability. Next, this process is also followed in case of reduction of credit already distributed for any other reasons. The example, when the credit is distributed to wrong recipient. Next, recovery of excess credit distributed to a recipient. Section 21 will be what is this? Excess credit distributed can be recovered along with interest only from the recipient and not from IST. Not from IST, only from recipient along with interest at the rate of 18% will be correct. So if the ISD had distributed excess credit to any recipient, the excess will be recovered from the recipient with interest as if it was tax not paid by the initiating actions under section 73 or 74. Section 73 or 74. Penalties may be applicable depending on the circumstances. Here ISD would also be liable to general penalty under section 122. That is general penalty. I think it may be 25,000 will be penalty, general penalty. Next, how ITC is utilized. How ITC will be utilized. ITC will be utilized based on, if you have an ITC, CGST paid or SGST paid or HGST paid or CGST, HGST, UTGST, whatever amount you have paid and whatever ITC you have, you must utilize it based on apportionment sum. So how can you can utilize it? How can will be utilized? If you are a supplier making interstate and imported purchases, he is eligible for ITC like this: interstate purchase tax paid, interstate purchase tax paid IGST, imported goods basic custom duty IGST. So he is having ITC of CGST, HGST, ITC of IGST, ITC of IGST. So the person may use the ITC to pay his output tax liability. To pay to output tax liability. As we know that Indian GST is a dual GST, wherein two taxes, that is CGST, HGST and UTGST, are levied currently on supply transactions, while the CGST revenue accrues to central government. The HGST and UTGST revenue accrues to state government. The CGST will go for central government, HGST, UTGST go for state or union territories. Hence, ITC of CGST, HGST, UTGST are interchangeable, and thus cross utilization of CGST, HGST, UTGST is not possible. Only CGST, HGST, UTGST cross utilization is not allowable, but IGST is cross utilization is allowable. IGST is a transitionary tax. IGST paid by taxpayer initially goes to the central clearing authority. ITC of IGST can be utilized for payment of CGST, HGST, UTGST. So cross utilization of IGST is available, but cross utilization of CGST, HGST, UTGST is not permissible. So flexibility has been provided to the taxpayer to utilize the ITC of IGST. If there is an IGST input, if there is an IGST payable, you can first utilize it for ITST payable, and if any remaining ITC credit related to IGST, you can have flexible to use that amount as such as you required. You may use for CGST, or you may use for HGST, or you may use for UGTST, or you may use it in proportion to CGST, HGST. Whatever credit flexibility is there for you. Next, ITC of IGST, output tax liability, in any order and in any proportion you can use. ITC of IGST to be completely exacted mandatory. First, it must be completely exacted mandatorily. CGST not permitted. SGST, UTGST only after ITC of CGST has been utilized fully. Next, not permitted. Output liability will be IGST. Output CGST liability. Output HGST, UGST liability. Okay. So IGST will be utilized for, first you will use for IGST liability, and after that you can use for CGST or HGST. If you have a CGST, CGST will be allowable only IGST will be allowable only for CGST and CGST. IGST, CGST, not for HGST or UTGST. Next, if you have a CGST, HGST, UTGST, then first utilized only after ITC of CGST has been utilized, and remaining amount will be allowed to output CGST, SGST or UTGST liability, not permitted to CGST liability. The numerous number given above was furtherly IGST credit should be first utilized towards payment of IGST, Next, remaining IGST, if any, can be utilized toward payment of CGST and SGST, UTGST in any order, in any proportion, or in any proportion. Remaining ITC of IGST can be utilized first towards payment of CGST and then towards payment of SGST, or first towards payment of SGST or then towards payment of SGST, or first towards payment of CGST, SGST. Simultaneously, there may be any proportion you can use, that is 50:50, 30:30, 30:70, whatever ratio you want you can use. In their ITC of IGST should be fully utilized before utilizing of ITC of CGST or SGST, UTGST. ITC of CGST should be utilized for payment of CGST only first and IGST in that order. ITC of IGST cannot be utilized for payment of SGST and UTGST. Next, ITC of SGST, UTGST should be utilized for payment of first SGST, UTGST and ITGST in that order. However, ITC of SGST, UTGST should be utilized for payment of IGST only after ITC of CGST has been utilized fully. Next, it cannot be utilized for payment of CGST. Cross utilization is available only between CGST, IGST and CGST, UGST or IGST. The cross utilization is not available to CGST or SGST. Next, CGST credit cannot be utilized for payment of SGST or UTGST, and SGST credit cannot be utilized for payment of CGST. Example number 15. What is there in example number 15? That is head SGST credit, CGST credit, output tax liabilities. There is heads of IGST, CGST, SGST. Next, output tax will be, liability will be 1000, 300, 300. Next, ITC available will be 1300, 200, 200. So, here ITC will be 1300. So, first utilized for that 1000 rupees payment. First utilized for 1000 rupees. And remaining 300. You may use for CGST or SGST, whatever portion you want. So, first ITC of CGST utilized, first discharge the liability of IGST. After that, you may use it in any proportion. Here, first option is using CGST 200, SGST 200. Next, or another option will be if CGST will be utilized only for CGST only. SGST will be used only for SGST only. Next, option 2 will be CGST, IGST will be using 200 rupees for SGST and 100 rupees for CGST. Whatever option you may choose, there is no compulsion for using the proportions. Next, restriction on utilization of ITC, that is Rule 86A. As per Rule 86A, there is restriction for utilization of ITC. You cannot utilize the ITC. In some cases. That is Rule 86 will be explained. What is there in Rule 86? In Rule 86, the commissioner or officer who is not below the rank of assistant commissioner authorized by him is empowered to impose restrictions on utilization of ITC. They may impose the restrictions for utilization of ITC available in the electronic credit ledger if he has a reason to believe that such ITC has fraudulently availed or ineligible. If there is ITC in your electronic credit ledger, if you have obtained that amount in fraudulent manner, then that assistant commissioner or who is person having not below the rank of authorized person, he may stop for utilizing that ITC. The restriction can be imposed in the following reasons. That is, ITC has been availed on the basis of tax invoice or valid document. Imposed on restrictions. ITC has been availed on the basis of tax invoice or valid document and issued by a non-existent supplier. There is to that person supplier is non-existent, or by a person not conducting any business for registered place of business. If one person is not having any registered place of business, he is issued that invoice. Next, without receipt of goods or services or both, there is no receipt of goods, only we have invoice, then that case, then the tax in relation to which has not been paid to the government, tax amount was not paid to the government. So restriction can be imposed based on following the status. It is available, we are ITC available based on tax invoice or valid document, but that issue investment is that invoices issued by existent supplier or by person not conducting any business from the registered place of business, or without receipt of goods or services or both, or in the tax in relation to which he has not been paid to the government. Next, the registered person availing ITC has been found that non-existent or not to be conducted any business from the registered place of business. Next, the registered person availing ITC is not in possession of tax invoice or valid documents. He is a person not having right to issue, so that person is issued. If the ITC so avail, the restriction can be imposed by the not allowing such ITC to be used for discharging any liability. If you have any liability in your books based on your sales or output liability, you cannot discharge that liability based on these credits. Next, such restriction can be imposed. Such restriction can be imposed for a period up to 1 year from the date of imposing of such restriction. So, for 1 year they may impose the restriction. However, commissioner or officer authorized by him can withdraw such restriction if he is satisfied that the condition for imposing the restriction no longer exists. Next, restriction on use of amount available in the electronic credit ledger. If you have an amount in electronic credit ledger, they are restrict for use of that amount. That is rule 86b. Rule 86b. What is there in rule 86b? When will it applicable? Rule 86b will be applicable when rule 86 is applicable to the registered person having value taxable supplies, that is other than exempted supply and zero rated supplies in a month exceeding 50 lakhs. So when the value of taxable supplies exceeding 50 lakhs in a month exceeding 50 lakhs, therefore in case where the value of taxable supplies in a month is less than 50 lakhs, then this restriction would not be applicable. So rule 86b will come in force when the amount was taxable supply was exceed 50 lakhs, then only this restriction will come into existence. Nature of restriction. What this restriction was tell that, what this restriction will be trying that, if you have on any liability, for example, if you have a liability of 1 lakh rupee payment, so you must pay that 1 lakh rupee up to 99% in credit ledger, means 1 lakh into 1% will be 1000 rupees. They will allow to pay in cash 1000 only. They will not allow remaining amount will be paying through cash. So the registered person to whom the said rule is applicable cannot utilize input tax credit in excess of 90% of the output tax liability. Even though you have an input of 1,05,000, you can utilize for 99,000 and remaining 1,000 you can pay with cash. They will not allow more than 99% if your turnover amount exceeds 50 lakhs in that month of the output tax liability while discharging output tax liability. So above restriction can be explained with the help of numerical example. For example, example 51. The total value of interstate supplies of Honors and Sons for the month of February 2021 is 100 lakhs. How much they have in February month? 100 lakhs. That is exceeded 50 lakhs. Said supply is taxable at the rate of 18% IGST. So it will be taxable at the rate of 18%. Okay. Thus total output tax liability of Honors and Sons is 18 lakhs. So output tax liability is 18 lakhs. So out of 18 lakhs, amount available in a credit ledger is 20 lakhs. So he is eligible for 20 lakhs amount, but as per rule 86b imposition, he will not utilize fully credit ledger. you must pay some cash to the government. You must pay to the cash to the some government. That is, in terms of restrictions imposed by Rule 86B, owners and sons can discharge 99% of its output tax liability. That is, 18 lakhs is output tax liability, no, and that amount 99% will be calculated. 17 lakh 82,000 will be utilized based on credit ledger, and remaining amount, whatever the remaining amount 18,000, you must pay through electronic cash ledger only. This is exception to the rule of 86B. If you have a payment of tax more than 1 lakh, if you have a payment have more than 1 lakh, then you can confirm exception. Next, rule 86B may not apply in cases where the person mentioned below have deposited sum of more than 1 lakh as income tax under the Income Tax Act in each of the last financial year. If you are paying the income tax for last 2 financial years, the amount will be more than 1 lakh at the time of filing of returns as per section 139(1) of the said act. Expired, the registered person or the karta or proprietor or managing person or registered persons, if any person is paying more than 1 lakh in their respective income tax, or who is the authorized person is there, no, that authorized person is paying tax of more than 1 lakh, then this rule 86B will not be applicable. It will come under exception. Then when you come under the exception, you may utilize it fully. You should not pay any tax with cash ledger. Next, receipt of refund of input tax credit. That is, refund of input tax credit for more than 1 lakh. Rule 86B may not apply where the registered person has received a refund amount of more than 1 lakh on account of unutilized ITC credit under following cases. That is, zero rated supplies made without payment of tax, inverted duty structure. Next, it pertains to note that refund should have been received in the preceding financial year. Next, payment of total output tax liability through electronic cash ledger in excess of 1% of total tax liability. If the registered person has paid more than 1% of total output tax liability using electronic cash ledger up to the said month in the current financial year, the restriction is specified in Rule 86B shall not be applied. For example, assuming a scenario where in the financial year 21-22 up to August 21, the total output liability payable is 30 lakhs and such registered person has deposited 1 lakh. So, he has deposited 1 lakh. Output liability will be 30 lakhs and through electronic cash ledger and balance through electronic cash ledger. Rule 86B shall not be applicable in September 21. If the turnover during this month exceeds 50 lakhs. So, if even though amount, if the amount will be calculated 30 lakhs into 1%, it will become 30,000. If you are paying using cash of 1 lakh, then rule 86B will not be applicable. Next, interestingly, the aforesaid exception need to be evaluated in the current financial year, and hence for the month of April of any financial year, the said exception will not be applicable. Accordingly, the registered person would have required to pay minimum 1% of output liability through electronic cash ledger unless the registered person is covered under any other exceptions if the total taxable turnover in the month is less than 50 lakhs. It is pertinent to note that GST liability paid under reverse charge mechanism should not be taken into account while calculating the total output tax liability paid through electronic cash ledger. So here, payment of cash ledger 1% condition is there, no, that 1% condition, this paying cash through RCM will not be added, because paying of reverse charge mechanism, it will you must pay through cash only. They do not have any option by using electronic credit ledger, so it will not accumulated for that rule 86B condition of 1%. Next, rule 86B would not applicable in case of below mentioned registered person, that is government departments, public sector undertakings, local authorities, statutory bodies. These 4% rule 86B will not be applicable, that is government departments, public sector undertakings, local authorities or statutory bodies.
Next, however, commissioner or an officer authorized by him in this PF may remove the said restriction after such verification and such safeguards has been deemed fit. Here, exception to Rule 86P is explained with the help of diagrammatic representation. Diagrammatic representation they are explaining. This is first. First one will be income tax payment more than 1 lakh. Income tax will be paying more than 1 lakh. If you are paying income tax more than 1 lakh by your authorized person, who is that authorized person? Maybe by your registered person or proprietor or karta or managing director of registered person or any two partners whole time directors. If you are paying income tax more than 1 lakh in your income tax, then this rule 86 will be not applicable. So you can utilize any amount. There is no restriction of 1%. Next, receiving refund of unutilized ITC. If you are receiving any refund unutilized ITC relating to zero rated supply without payment of tax, that is registered person received refund more than 1 lakh with respect to unutilized ITC on account of zero rated supply without payment of tax. Next, receive refund of unutilized ITC relating to inverted duty structure. If a registered person received refund of more than 1 lakh with respect to unutilized ITC on account of inverted duty structure. Next, it is not applicable to specified persons, that is government department, public sector undertaking, local authority and statutory body. These 4 persons will not be applicable for this 1 person case. And payment of cash in excess of 1 person of total output liability. Anyway, you are paying cash through cash that was the amount exceeded already 1%, then it will not applicable rule 86B. And proper officer authorized to remove restrictions. If some persons who is maybe list the persons, that is commissioner of an officer authorized by him in this behalf may remove the said restriction after such verification and such safeguards has made deemed fit. So some person may be removed from paying the tax even though they have credit of 1%, have 1% paying. Illustration number 2. Determine the amount of tax payable through electronic cash ledger, electronic credit ledger or electronic cash ledger from the given information. So taxable turnover of ABC Limited in the month of February, that is 1.25 crores, 1.25 lakhs, 1.25 lakhs, that is it is exceeded 50 lakhs. Okay, it is exceeded 50 lakhs excluding zero rated and exempted supplies. Okay, total amount of input tax credit as per books for the month of February will be 25 lakhs. And total amount of input tax credit as per GSTR 2A to be for February month 22 lakhs. In books we have 25 lakhs and in GSTR 2B we have 22 lakhs. We can calculate based on this. For matching amount 22 lakhs, base 22 lakhs into 5%. Provisional amount of 5% will be calculated. That amount only we will available for claiming the ITC, and in excess of 5% means 105% you cannot claim the ITC. And if any amount is payable, that is whatever amount is liable at the rate of 18%, it may be 18% means you will get the tax amount. No, whatever tax amount if you get that tax amount, if you get the amount of 20 lakhs for example 20 lakhs, you must pay the 20 lakhs into 1%, 18 lakhs through credit ledger, 2 lakhs through cash, for example that one. So answer will be seen that in the given case ABC Limited would be liable to pay tax at 22 lakhs 50,000, that is our turnover will be 1.25 crores no into 18%, that is 22 lakhs 50,000. So 22 lakhs 50,000 into 99%, whatever amount you can pay through credit ledger, remaining 1% what way 2 lakhs 250,000, 2 lakhs 25,000 I think so, 2 lakhs 25,000 must pay through cash. 1% means 22,500 will come. Okay, 22,500 will be paid through cash only. Next, in terms of rule 36 of CGST rule, first rule 36(4), what rule 36(4) explain that you must 5% case reported 5% cases, that is rule 36(4), the availment of ITC is restricted 5% of reported invoices, that is Invoice and unreported invoices auto-formulated in GSTR 2A, GSTR 2B. Hence, ABC Limited would entitled to avail input tax credit of 22 lakhs plus 22 lakhs into 5%. That is 23 lakhs 10,000. He is eligible for 23 lakhs 10,000. 23 lakhs 10,000. He is eligible for 23 lakhs 10,000. But what is our tax liability? 22 lakhs 50,000. So we will utilize full amount 22 lakhs 50,000. No problem. Next, it can be seen from the above that ABC Limited can pay entire tax liability through utilization of available input tax credit. It pertains to note that taxable turnover of ABC Limited for the February 2021 is more than 50 lakhs. So, when there is turnover exceeds 50 lakhs, then rule 86B will applicable. Rule 86B, what the rule 86B will applicable? Here rule 86B tells that ABC Limited cannot use ITC in excess of 99%. In excess of 99% of output tax liability in the instance scenario. Therefore, output tax liability 22 lakhs. Whatever the 22 lakhs paid in the following manner. That is 22 lakhs 50,000 into 99%. That is 22 lakhs 27,500, and the remaining amount paid through cash ledger. Next, illustration number 3. What is there in illustration number 3? PQR Company Limited, registered supplier in Bangalore, Karnataka, a manufacturer of goods. The company provides following information pertaining to GST paid on inward supplies during the month of April. So, during the month of April, they are provided their information. Okay. What is the information? Life insurance premium paid by the company for their life of insurance factory employees as the policy of the company. If there is policy of the company, so there is no legal obligation for insurance for employees. So it is a black credit. It will not be eligible for claiming the ITC because there is no obligation from any act. Next, raw materials purchased for which invoice is missing but delivery challan is available. If you want to claim any ITC, you must have tax invoice. If you do not have any tax invoice, you cannot claim the ITC. So 38,000 will not be allowable as ITC. Next, raw material purchases which are used for zero rated supply. In case of zero rated supplies, so raw material used for zero rated purchases, even though the raw material, if you paid the tax amount, you used for zero rated supplies, you can claim that ITC. That is 50,000 is eligible for ITC to claiming the ITC. Next, raw material purchases which are used, work contract services used for repair of factory building which is debited in the profit and loss account of company. Normally, work contract will be services will be black credit if that construction related, but it is related to repairs, that is revenue expenditure, it will be allowable. So 30,000 will be allowable. Now 50,000 plus 30,000, 80,000 will be allowable. Next, company purchased the capital goods for 4 lakhs and claimed depreciation of 44,800. So 44,800 was claimed, and 10% of full amount of 4,48,000 under Income Tax Act 44,800. It has claimed 48,000. So when you are claiming depreciation, then ITC is not available. On this amount, ITC is not available. Up to this 50 plus 30, 80,000 is available. Next, other information. In the month of September of previous financial year. Now we are in April month, and they are providing the details of previous month. That is, avail ITC of 2,40,000 on purchase of raw materials which was directly sent to the job worker premises under a challan. So we are send some amounts to on 25th September previous financial year. The said raw material has not received back for the job worker up to September. Up to April you have not received. Up to April for current financial year you have not received. So the amount, it is also not received. So September means last year, valid year, and since from year September to September for the amount. So it is no tax liability will be arise here. Next, complete the last one. All the above inward supplies except CN number 1 above have been used in the manufacture of taxable goods. Inward supplies at and serial number 3 above have been used for manufacture of exempted goods. What is there in 3? Raw material used which are used for zero rated supplies. So zero rated supplies it will be allowable, no problem. Next, compute the amount of net ITC available with PQR Company Limited for the month April with necessary explanation for the treatment of various items as per provisions of CGST Act subject to information. So we have calculated what amount we have got, only 80,000 we have got. So see the answer. Computation of ITC available with PQR Company Limited for the month of April, that is life insurance premium paid by the company and life insurance of factory employees is not allowable. Note 1. Raw materials purchased. Note 2. Not available. Raw materials used for zero rated supplies is allowable. 50,000 is allowable. Work contact services, this is related to repairs, so we have claimed 30,000 is allowable. Capital goods purchased in respect of which depreciation is claimed on tax components is not allowable. Goods sent to job or premises, note 6 is not allowable. Total ITC available will be 80,000. So note 1. What is there in note 1? That is ITC and life insurance service is available only when it is obligatory for an employer to provide services to its employees under any law for the time being enforced. So since it is not obligatory for the employer in the instant case, here instant case here employee is no obligation, so that is ITC there on will be blocked credit. Next, ITC cannot be taken since invoice is missing and delivery challan is not a valid document to avail the ITC as per section 16(2). In case of upon employer-employee section 17(5). Next, ITC can be availed for making zero rated supplies, notwithstanding that supply may be exempted, and even though the supply is exempted supply, if you use the inputs, if you have paid the any tax on inputs, you may claim, there is no restriction. Next, ITC is a blocked credit on work contact related, the ITC will be blocked credit, but for when supplied for construction of immovable property, if you supply for construction of immovable property, however construction includes only that repairs which are capitalized along with the said property. In this case, since repairs of building is debited to profit and loss account, the same does not amount to construction and hence ITC therein are available. Next, ITC is not available when depreciation has been claimed on the tax component of the cost of capital goods under Income Tax Act 16. So section 16(3). Next, principal is entitled to take ITC on input sent for job work even if the said inputs are directly sent to the job worker. So principal is eligible for claiming that ITC. However, where the said inputs are not received back by the principal within a period of 1 year, from the date of receipt of input by the job worker, it shall be deemed that such inputs have been supplied by the principal to the job worker on the day when the said inputs was received by the job worker. Here, hence, the ITC taken by PQR Company, by a PQR Company Limited in the month of September. They are already claimed in the month of September when they are sent that ITC, when they are sending that related products to job worker. And last year is valid, and since 1 year period has not yet lapsed in April, so only 6 months is completed. In 1 year his time, there is a time limit, there will not be tax liability on such inputs. Next, illustration number 4. What is there in illustration number 4? Siddhi Limited is a registered manufacturer. Engaged in taxable supplies of goods. Siddhi Limited purchased the following goods during the month of January. The following supply particulars are provided by the company. So capital goods purchased on which depreciation has been taken on full value including GST paid on 15,000. So when you have claimed the depreciation and capital goods, you will not eligible for ITC. Next, goods purchased from Ravi Traders. Invoice of Ravi Traders in the received in the month of January, but goods are received in the month of delivery March. So whenever the goods, in case of momentum of goods, the goods delivery taken place will be supply. So in the month of January it is not a supply. In the month of March only we can claim the ITC. Next, car purchased for making further supply, car purchased for making further supply of such car is destroyed in accident while being used for test drive by potential customers. If any product is destroyed on that input, you cannot claim the ITC. So 30,000 ITC is not available. Goods used for setting up telecommunication towers. For construction of immobile property, it is a blocked credit. Is 50,000 is not allowable. Like trucks purchased for delivery of finished products. If trucks purchased for finished product, it will be eligible, because our finished product is output product. Finished product, they are delivering that product, then that truck ITC will be allowable. So 80,000 will be allowable in this case. So determine the amount of ITC. Determine the amount of ITC with Siddhi Limited for the month of January, giving the necessary explanation for treatment of various items as per provisions of CGST Act, GST information. So computation of ITC available with Siddhi Limited for the month of January. So capital goods nil. Note 1, goods purchased for Ravi Traders. Note 2, nil. Next, car purchase for making further supply, nil. Note 3, next, goods used for setting telecommunication tower. Note 4, nil. Trucks purchased for delivery of output goods. Note 5, 80,000 allowable. 80,000 will be allowable. Total ITC available with Siddhi Limited will be only 80,000. That is note since depreciation has been claimed on tax components of the value of capital goods. The ITC of such tax cannot be availed in terms of section 16.3. If you have claimed the depreciation, you are not eligible for claiming the ITC as per section 16.3. Next, in respect of ITC, in respect of goods not received. If you have not received any goods, you cannot claim the ITC available as per section 16.2. Since goods have been received in the month of March, ITC therein can be available in the month of March and not in the month of January. Even though you have an invoice for the same has been received in the month of January. Next, through ITC and motor vehicle used for further supply of vehicle is not blocked, but ITC on goods destroyed for whatever reason is blocked. So if the product is destroyed, then ITC will become blocked as per section 17.5. Next, ITC on goods used by taxable person for construction of immobile properties other than plant and machinery on his own account is blocked even when such goods are used in the course of furtherance of business. When the property related to construction of immobile property other than plant and machinery, that ITC will be not eligible. However, explanation section 17 excludes telecommunication towers from the preview of plant and machinery. So from plant and machinery, telecommunication services was excluded. So ITC will be not allowed. Next, fifth point, section 17.5a, block of ITC with respect to only those motor vehicles which are used for transportation of persons, albeit with certain exceptions. Persons related to that sitting capacity will be not less than 12%, and thus ITC on motor vehicles used for transportation of goods also are allowed, and in case of person there is certain limitation. That is, limitation was if it is a capacity will be less than 12%, it will not be allowable. Less than 13%, the persons not allowable, including the drivers. Next, what is there in next question? Wow, ITC chapter was completed. Test your knowledge questions will be provided in next video.